Okay, so derivatives. They sound kind of like something only Wall Street guys in suits need to worry about, right? We're going to unpack these things, why they actually matter to, everyone, even if you've never even thought about buying an option or anything like that. We're diving deep into Let's Talk About Derivatives by Ricky Fernandes. And let me tell you, this author, he really gets it. He knows how this stuff really works. You know what I mean?
Yeah, it's fascinating, really. Derivatives, they pop up everywhere in the global economy, often in ways that, most people don't even realize, like the price of, say, groceries, or even like how stable the financial markets are. Derivatives are kind of behind the scenes in all of that.
Yeah, and Fernandez, he really lays that groundwork. In chapter 1, right from the start, he digs into the basics.
Mhm.
He says derivatives get their value from something else. It's called the underlying asset. This could be stocks or it could be bonds, commodities, really, you name it. So it's like you're making a side bet on something else, right?
Mhm. Exactly, a side bet. And you can use that side bet in a few different ways. Chapter 1, he breaks down the big three: hedging, speculation, and arbitrage. Hedging, that's all about managing your risk, trying to protect yourself from, losing money, kind of like buying insurance, but for your investments, for your portfolio.
So using derivatives to hedge is like you're saying, okay, I'm a little worried that this investment might go down, so I'm going to make this other bet just in case so I don't lose everything.
Exactly. You got it. Now, speculation, that's a whole different ballgame. That's when you're betting on which way the market is going to go, up or down, hoping to, make some money off those price swings. Higher risk, but hey, potentially higher reward, right?
Okay, so we've got hedging, which is about managing risk. Then there's speculation, which is all about, like you said, placing a bet and hoping for the best.
Mhm.
What about that third one? Arbitrage, I think Fernandez called it.
Oh, arbitrage. That's a good one. That's all about spotting those tiny price differences, in different markets. Imagine this. You buy something, let's say, for $10 in one place, and then you turn around and sell it immediately somewhere else for $10.50. Boom. You just made a profit just from that little difference. That's arbitrage.
Interesting. And all three of those things, hedging, speculation, arbitrage, they all happen in the derivatives market.
Absolutely. Derivatives give you the tools and flexibility to do all of that. And to really get how derivatives impact, the whole financial world, you got to understand how each of these strategies actually work.
Okay, so we got the different ways people use them. But what about the types of derivatives? Chapter 1, he mentions forwards, futures, options, swaps. It's a lot to take in.
It can seem like a lot, yeah. Let's start with forwards and futures. Think of them like you're making a deal today to buy or sell something, but at a price that's set for like way in the future.
So it's kind of like pre-ordering something, but for like stocks and stuff instead of a new phone or whatever.
Exactly. You got it. It's like pre-ordering financial stuff. Imagine, let's say, you're a farmer, right? And you're worried about the price of corn going down before you can harvest it. So you could use a futures contract to lock in a price for your corn that you'll sell later. Even if the price drops later on, you're protected.
Okay, that makes sense. So forwards and futures are all about locking in a price for the future. What's the difference between those two?
Good question. Forwards, they're like private agreements between just two people. Futures are standardized contracts that are traded on exchanges. Think of it like, I don't know, buying a custom-made suit versus just buying one off the rack. They both serve the same purpose, but one is more, tailored to you.
Right, I get it. And Fernandez, he uses that example with airlines, right? They use futures contracts to lock in the price of fuel.
Yeah, exactly. Classic example of hedging. Airlines, they need a ton of fuel, and if the price of fuel goes way up, that really hurts their bottom line. So those futures contracts, they help them manage that risk.
Okay, that makes sense. Forwards, futures, got it. What about options? Those always seem kind of tricky to me.
Options, yeah, they're interesting. They basically give you the right to buy or sell something, an asset. But here's the thing. You don't have to buy or sell if you don't want to. You have the option to, up to a certain date.
So it's kind of like when you make a reservation at a restaurant, but you don't actually have to show up if you, I don't know, change your mind.
Exactly. You got it. You have the option to use that reservation to buy or sell, but you don't have to if you don't want to. And this flexibility, it's what makes options really popular with investors.
I can see why. And Fernandez, he talks about different kinds of options, call options, put options. Can you break those down a little bit?
Sure. So a call option, it gives you the right to buy an asset at a certain price. And a put option, that gives you the right to sell at a certain price. It's like, let's say you're really confident that a stock is going to go up. You're bullish on it, as they say. You might buy call options because you think you can make a profit off that. But if you're bearish, if you think a stock is going to go down, you might buy put options, hoping to, again, make a profit from that.
Interesting. And then there are those exotic versus vanilla options that Fernandes talks about in Chapter 3. What's the deal with those?
Yeah, so think of vanilla options like your basic tools, like the standard stuff you'd find in your toolbox. They're straightforward. Everyone uses them. Exotic options, on the other hand, they're more specialized, like having a custom-made tool for a very specific job.
Okay, so if vanilla options are your everyday tools, when would you actually need one of those, what were they? Exotic options.
Right, exotic options. Let's say you're like a hedge fund manager, right? And you've got this hunch that a certain stock is going to go through the roof, but only if, like, a specific merger happens. An exotic option, that could be set up to, pay out a ton of money, if that merger actually happens. A vanilla option, that wouldn't really work in that situation.
Gotcha. So it's like, I'll make this bet, but only if this very specific thing happens. High risk, but yeah, could be a big payoff.
Exactly. Now, chapters 2 and 3, Fernandes goes deep into how all these different contract types work. We could probably talk for hours about the nitty-gritty of each one. But the important thing to remember here is, these are tools, and yeah, they're complex, but they're just building blocks.
Building blocks for what? What do you actually do with them?
Building blocks for those, really complex trading strategies, the ones you hear about, and for managing risk and even, finding those little loopholes in the market, the inefficiencies. And that's where things get really juicy, especially when you get to chapter 4.
Okay, so chapters 1 through 3, that's like the intro, laying the groundwork. And then chapter 4 is where Fernandes takes us backstage, shows us the real deal, how the pros do it.
Exactly. It's like he's pulling back the curtain, showing you what's really going on. He talks about things you won't find in a textbook, like, for example, dynamic hedging. It's completely different from the buy and hold strategy that a lot of investors, they just buy something and hold on to it.
Dynamic hedging, what's that all about? That sounds pretty hardcore.
It is. Basically, you're actively managing a portfolio, a bunch of derivatives, and you're constantly adjusting based on what the market is doing, like every second. It's like, imagine a captain of a ship, right? They're always adjusting the sails to deal with the wind and the currents, It's all about adapting and rebalancing constantly.
So it's not like you just, make a bet and then just sit back and wait. You're always got to be paying attention, looking at the data, adjusting things.
Yeah, exactly. And to do it right, you need some serious computer power, real-time data, and traders who can think on their feet make those split-second decisions.
Fernandes, he uses that example of the portfolio manager at the hedge fund. They might use that strategy, the protective put, to protect their investments if the market starts going down. But they're not just buying those put options and then, clocking out for the day.
Nope, not at all. They're constantly glued to the market, adjusting how many contracts they have, fine-tuning everything based on every little movement.
Wow, that sounds ridiculously complicated. No wonder they say the textbooks don't really tell the whole story.
Yeah, and it's not just about how complex the strategies themselves are. Fernandes, he gets into some of the other, I guess you could say, the dangers out there, things people don't always think about, like counterparty risk, especially with those over-the-counter derivatives.
Counterparty risk, so that's like the risk that the person you made the deal with, the other side, they just, disappear or something and can't pay up.
Exactly. Like lending money to someone without even checking their credit score, it might be fine, but what if they just, never pay you back? And in the world of derivatives, that kind of risk, it can spread like wildfire,
That's kind of what happened in 2008, right? With the whole financial crisis.
Exactly. When Lehman Brothers went under, it was like a shockwave. Everyone was freaking out because they were all connected, all those counterparty relationships. And suddenly everyone's wondering, wait, is this other company going to be able to actually pay up? Or are they going under too?
Man, that's a scary thought. So how do you, protect yourself from that?
Fernandes talks about collateral agreements, and those credit support annexes. Basically, they're like safeguards you build into the contract itself just in case one side can't pay up. Think of it like a security deposit when you're renting an apartment. It's there to cover any damages just in case.
So it's like a safety net, just in case things go south.
Exactly. But even with those safeguards, you're right, derivatives, they can be risky business, especially when you start getting into the really complicated stuff that Fernandes talks about. He's got a whole section on shadow trading, which is fascinating, but it's kind of, not exactly transparent.
Shadow trading, man, that sounds shady. What is that?
Imagine a huge company, maybe a pension fund or something, and they want to make a big investment in a certain stock. They go to an investment bank and they place a huge order for options. Now, the bank, they know about this giant order, right? So they might decide to buy up a bunch of that stock beforehand, before the price goes up when the order goes through.
So they're kind of like profiting from insider information, even if it's not technically insider trading.
Yeah, it's kind of a gray area, legally speaking. They call it pre-hedging. People don't talk about it much, but it happens, and it has a real impact on how the markets move.
Wow. And Fernandes, he doesn't shy away from that stuff. He also mentions gamma scalping and regulatory arbitrage.
Hmm.
Both of those kind of sound like, finding loopholes in the system, pushing the boundaries of what's allowed.
Yeah, you could say that. Gamma scalping, it's the super fast trading strategy where you try to make money off of how much the price of something is changing. Instead of betting on if a stock is going up or down, you're betting on how wild the ride is going to be, how much it jumps around.
So instead of like betting on the horse race, you're betting on how much the horses are going to be freaking out during the race.
Exactly. You need to be really fast to do it, special algorithms, and you got to really know those options pricing models inside and out.
Sounds intense. What about regulatory arbitrage? That sounds like it could get you in trouble.
It can. Basically, you're taking advantage of the fact that, different places have different rules, different regulations, or even if it's the same set of rules, you're finding those loopholes, those little inconsistencies.
So it might not be technically illegal, but it's kind of like, pushing it.
Exactly. Like a company might set up a derivatives trade in a way that lets them pay less in taxes, or maybe it reduces how much capital they have to keep on hand.
So it's like those guys who know the tax code inside and out, and they find every little deduction, even if it's not really what the lawmakers had in mind.
Right. And Fernandez, he doesn't say whether it's right or wrong. He's just showing you how it all works, the good, the bad, and the ugly.
So he's giving us the real behind-the-scenes tour of the derivatives market. It's not all pretty, but you got to know how it really works.
Exactly. Because even if you're not, a high-flying trader, this stuff affects everybody. It's all connected.
This is giving me a lot to think about, for sure. What else does Fernandes cover in Chapter 4?
Yeah. So, Chapter 4, man. We covered some serious ground here. We started with the basics like forwards and futures, and now we're talking about like dynamic hedging and regulatory arbitrage. What else is in there?
Well, he gets into some of the things that, even the pros, they got to worry about, like liquidity and slippage. Have you heard of those? Yeah, I think so. It's been a while since finance class, though. Remind me what those are again.
Sure. So liquidity, that's basically how easy it is to like buy or sell something without messing up the price. Think of it like this. It's way easier to sell, I don't know, a used Toyota Camry than it is to sell some rare like vintage sports car, right? The Camry, that's what they call a liquid asset.
Okay, yeah, that makes sense.
Yeah.
So where does slippage come in?
Slippage, that's the difference between like the price you think you're going to get for something and the price it actually goes through at. It's like you go to buy that used Camry and right when you're about to pay, the seller says, "Oh, actually, it's going to be $500 more now."
Oh, man, that's the worst. So you're saying even if you think you've got a good price on a derivative, this slippage thing could mess it all up.
Exactly. And it's a bigger risk when you're dealing with those less liquid derivatives, the ones that not as many people are trading. Fernandes, he says that the big institutional investors, they really have to watch out for this because they're trading such huge amounts that even a tiny price difference can mean big losses.
He gave that example of like breaking up a big order into smaller pieces so you don't spook the market.
Yeah, exactly. Or they use those fancy algorithms that spread out the trades over time. You don't want to like tip your hand and let everyone know what you're up to, especially if you're a big player.
Right.
That could backfire.
It's like when you're trying to, I don't know, sneak into a concert or something and you don't want to draw attention to yourself.
Exactly. Lay low, make your moves quietly. Now, another thing that Fernandes talks about is this thing called cross-asset correlation. That's a mouthful.
Cross-asset correlation, what's that?
It's all about understanding how different types of investments, like stocks, bonds, commodities, how they all move together or don't.
Okay, so it's not enough to just like focus on one thing. You got to see the bigger picture, right? How everything fits together.
Exactly. He uses the example of a company that's really dependent on the price of oil and also the value of the US dollar. When oil goes up, the dollar usually goes down, and vice versa. They move in opposite directions, you see.
Okay, and that's important for them to know so they can hedge against both of those things.
Exactly. They use derivatives to try to balance things out, to manage their risk on both sides. It's a lot to juggle, for sure.
It sounds like it. Fernandes also says that A lot of the stuff you see in textbooks, those pricing models, they assume that people are going to act rationally. But in the real world, emotions play a big role, don't they?
Oh, yeah, for sure. Fear and greed, those are big motivators, maybe the biggest when it comes to the markets. And derivatives, they can really amplify those emotions.
He talks about those volatility derivatives, like those VIX futures. Those sound kind of wild.
They are. The VIX, it's like the market's fear index. It measures how much everyone thinks the S&P 500 is going to jump around. And with those VIX futures, you're basically making a bet on how much fear there's going to be in the market.
So it's like betting on how scary the roller coaster is going to be.
Exactly. And when things are uncertain, people, they want to protect themselves, right? They're willing to pay a premium for that insurance.
That's when those VIX futures, those volatility things, that's when they become really valuable.
Exactly. Now, toward the end there, Fernandes, he gives us a peek into this other part of the market, the dark pools.
Dark pools. Okay, now that sounds a little ominous. What are those?
They're like these private exchanges, the big institutions, the ones with tons of money, they go there to make their trades in secret.
So it's like what do they call it, a speakeasy? Or like one of those exclusive clubs where you got to know the secret password to get in.
Yeah, I kind of like that. It's a way for the big players to do their thing without, moving the market too much.
It's amazing how Fernandez, he brings all these different parts of the derivatives market to light. The strategies, the risks, who the players are, all that behind-the-scenes stuff that most people have no idea about.
That's what I like about his work. He doesn't shy away from the complex stuff. Derivatives, they're way more than just some lines on a spreadsheet. It's a wild world out there.
It really is. So as we wrap up our deep dive into let's talk about derivatives, what's the one thing you want our listeners to take away from all this?
Derivatives, they can be powerful tools, but they're not for beginners, that's for sure. You can make money with them, manage risk, even get a leg up in the market, but you gotta know what you're doing.
It's like flying the plane. It's awesome if you know what you're doing, but you got to have the right training and respect the risks, or else you're going to crash and burn.
Exactly. So yeah, do your research, ask questions, and don't be afraid to start slow.
Words to live by. Well, on that note, we'll wrap up this deep dive into the world of derivatives. They're complex, they're risky, but man, are they fascinating. Thanks for joining us, and we'll catch you on the next one.